start with you, Andy. I was very puzzled seeing the chart where you're showing about how to finance, how company primary source their deal financing, and the development of, I think it was more than 50%, 52% of cash. And if I understand you correctly, you're arguing the reason for that is mainly high oil prices. Yeah. So one small question is, what kind of companies are in this portfolio? Because I guess downstream companies may see it differently than the upstream community. And then I guess in line with that, a little bit the question, is it not also a little bit showing the insecurity in the market, holding cash as a company, yeah, being risk averse, and also with the overall environment, getting back to the first session in terms of low interest rates, cheap money, or keeping the money is not too expensive for the time being.
Just see if this works. Yeah, there we go. That's quite a few questions. So I think it's true to say that the industry over the last 10 years really has thrown off huge operational cash flows, and that has made that certainly probably the operationally easiest route to go to raise cash, so it's to raise finance to invest. I think within the industry, the upstream does tend to dwarf the downstream in terms of cash flows, and that's probably why you see that bias in that questionnaire, which is industry-based rather than upstream, downstream-based. I think the other thing, I just go back to the point I made, that this industry has historically been always quite financially conservative. And I would go back to the formative experience of 98, 99, 2000 to explain why that is. I think so many of the people who are now in senior positions in the industry had sort of first-hand experience of the near-death experience the whole industry went through when the oil price got to $9, that they understand how important it is to keep flexibility in the balance sheet, and that we still see that as a pervasive attitude. In the short term, in the medium term, it may actually not be the most efficient way to go. With debt as cheap as it is at the moment, you would think that people would make more use of it. But I think it's that inherent conservatism and I think attitude that there's enough risk in the business already without having finance risk on top that perhaps drives the behaviours.
Nuttachat, to continue that, would you consider PTT as being, as Andy termed it, financial conservative? And if I look at your growth plans, which are truly globally, particularly in the E&P sector, looking at the game board you have, how much is financing an issue? And do you finance by cash, by debt in your programs?
We mainly finance through our bond issuing and partially IPO from the very beginning. That is the main source, and also from cash flow from our operation. But luckily that in our portfolio we try to balance between risk and return from both upstream and downstream, so we can move our finance. Right now, just like we feel that the pressure on the supply security is lessened from the surplus supply from US. So we move our portfolio more into the downstream side.
Alex, talking about risk, talking about finance, and talking a little bit about what you showed in terms of the different NOCs in terms of regional specific goals. We're saying that Asian companies or NOCs seem to be more looking for global opportunities, whereas South America, for example, more stays within the region. Yeah, how would you define how differentiation not only geographically, but also in terms of what we yesterday discussed a little bit also with Tony Hayward, in terms of technical risk, political, geopolitical risk, and how much this plays also into financing projects, and how the risk evaluation of, what is it better to go into technical risk, or is it better to go into geopolitical risk and more riskier assets like obviously probably Asian players might want to do?
Well, that's, again, many questions in one statement. I think in terms of maximizing return, if you are aligned along the geopolitical axis, you're probably better off going to high risk, high geopolitical risk areas, provided that you are comfortable in that environment and you're able to drive value in that environment. So, an example would be Africa and the mixed results that various companies have had going in and out of Africa. You see an exodus, to some extent, out of Africa from several IOCs. Selling assets. Marathon could be, an example in that context. And then you see, at the same time, companies like Petronas and CNOOC and Sinopec very, very keen to go back into that or to extend their footprint because they're well aligned along geopolitics. They understand the infrastructure needs of the region, and they're able to create a significant value. And usually they create that value more significantly if they start from scratch, i.e. joint venture or an equity position, rather than buying a company. Because we all can see some of the challenges, for instance, around some of the acquisitions that have been made. I won't mention any names, but they've been at very high valuations, and so the financial risk path has been less successful than the geopolitical risk path.
So if you having now Nuttachat BTT sitting next to you, what would your, as Ernst & Young, what would your recommendation be for the expansion plans of BTT? Going global, staying in the region, South America, Asia, Middle East, Europe?
Well, I think going global is inevitable. Outside of Latin America, and we explained the North-South America's axis, I think it makes a lot of sense for the entities there and the NOCs there to stay where they are. It's very difficult to argue with the Brazilian government or Petrobras go back in internationally, and it's worthwhile for you to do that, given that you've got a 200 billion or whatever it is capital project just on your doorstep, with all the challenges that entails. So for an Asian player, it's a very different situation. And there I see two sort of easy paths. One path goes into Middle East, and the other path goes into Africa. I think it's still very challenging, particularly for Thailand, Malaysia, to become a real player in the Russian context, given the competition that's there, the power of the IOCs there, and the Chinese players. So I would say Middle East. I think we're going to see a lot more opening up of the Middle East, and particularly cooperation with the Asian nations. And then the next, of course, is Africa, which has still huge potential.
Nuttachat, would you agree to that recommendations?
I take his advice.
Do you take this advice? Very good.
We try to stay in the area where we have comfortable to be in, and we right now, because and instead of trying to find more asset outside Thailand, probably we try to secure supply instead, because it's about the right time that we should do that.
Good. Also some questions from the floor. Please, the gentleman to the very right.
Hello, Jeffrey Woodruff from Fitch Ratings. Question for Andy. Actually, you mentioned early on in your presentation about cost overruns for projects. I was wondering if I could have your views on some of the Australian LNG projects, most of which seem to be over budget. They tend to make the press every once in a while, and I just was wondering if you felt that they've already reached the point of no return, where maybe they're white elephants, or they're reaching that point, or maybe there's still enough buffer that these projects can still be economically viable. Thank you.
Okay, I'll try and answer that without offending anybody. I think the position is that at the moment there's a whole series of projects that have a whole hierarchy of costs, and you can look at the costs both in terms of, say, costs per million tonnes a year construction costs, or you can look at costs in terms of, sort of built-up costs to deliver into Tokyo Bay. And if you look at the whole series of projects, and if you look at the split between the ones that are pre and post FID, then you can see that some of them are competitive with predicted costs from, say, exports from Canada or North America at a Henry Hub, $4 to $6, and some of them are competitive with East Africa, and some of them at the moment are not. And I think you see different ranges of the gap, sort of in terms of $2 per MMBTU average across all the projects. However, I think to say that that means some of them are white elephants is not right. I think what you've got in Australia at the moment is a very dynamic situation. There is, I think, a broad acceptance within Australia now that the industry has to take control of costs. The industry has got a whole series of initiatives underway now to take control of costs. Now, whether that's sharing infrastructure, whether that's changing the tax base, which is an option, I think there are things that can be done. I also think that you need to look at the other side of the equation, that the Australian cost estimates tend to be fully worked up post-FID, and some of the other estimates that we're seeing anyway are, I'd say, less worked up pre-FID, and just based on my own personal experience, I would expect there's quite a few surprises to come on some of those new projects coming on. So I don't think in any way, shape or form that you could describe the Australian projects as being inherently uneconomic. I think you can describe them as being projects which are going to need to be very careful about how they manage their capital and operational costs going forwards. And I think the owners of all the projects are going to have to look very long and hard now at how their project stacks in the overall economic profile, because we think over the course of the next 10 to 15 years, there's probably 100 million tonnes per annum more potential supply than there is potential demand in LNG. So not every project is going to get built.
Would such a project or cost overrun LNG or the projects we just mentioned actually call for long-term contracts which are linked to oil, or would it allow also international free market pricing as well? Or, I mean, in theory, the argument here would be perfect, saying, okay, we need this long-term security for these projects in terms of marketing.
I don't know. I mean, if I was the owner of one of these projects and I was sinking $10 billion into 3 trains, I would want to know that 90% of my revenues are locked. So I think I can understand why the owners are going for long-term contracting. Until we have surplus LNG cargoes available to build the spot market, then we are going to have long-term contracting as a huge proportion. There are various people now talking about building intermediate hubs and beginning to move towards some kind of spot pricing. If we get the North American stuff coming on with sufficient spare capacity, then obviously that might start to drive it in the same way that we began to see it going in that direction a few years ago when things were going in the other direction. But I think I would expect to see long-term pricing of some description, may not be oil-based, with us for quite some time to come yet.
I guess BTT would not be so much in favor of long-term oil index pricing as a buyer on the other side then, yeah?
Yes, because I learned from yesterday's speaker that many LNG contracts will be expired by 2017. I'd like to see what happened after that, so I feel reluctant to commit any to long-term contract, unless probably it will be Henry Hub link or partially Henry Hub link. That will be good for us.
I guess it's not only about the Henry Hub link, it's the premium you pay over the Henry Hub link, which is also then the interesting factor. Yeah? Any more questions? There's one.
This question is primarily to Alex. It's Ken Ume from Petrotechnics. You indicated, I think, that NOCs, part of their drive is to acquire new technology, amongst other things. Do you see that acquisition of new technology as being a simple incorporation of existing technologies within their targets, or the broader capability of recognizing technologies and applying them to sort of oil and gas production problems? Thank you.
Yeah, that's an excellent question, because there is a distinction, very much a distinction between those two. I think we're seeing NOCs wishing to move along a parallel path, a path that, one, strengthens their R&D capability and their ability to early on recognize promising technologies and develop technologies. I think PetroChina right now is the #1 investor in R&D globally, so that tells you something. But then secondly, the NOCs recognize they've still got a long way to go in terms of understanding and dominating technology. You see a lot of the wishes of many NOCs when they invest in deep water, particularly, especially ultra-deep water, when we're looking at Brazil and now Angola with its pre-salt adventures, is indeed to try to understand the mechanics, the guts of how do you go about drilling in 2,000 meters, 2,500 meters, and extract hydrocarbon with all the challenges that represents. So it's got two aspects. One, strengthen R&D, because you don't want to always be dependent on somebody else developing the technology. In addition to that, and we're seeing it strengthen the links to the service companies, because they have been innovators in the past and continue to be. And then number 3, acquire technology expertise through strategic investments, partnerships in international waters. Yeah.
There's one more question.
I'm Elchin Hassan from BP Azerbaijan. My question is that it may be misleading to talk about NOCs very generally, and there is how I need to distinguish between NOCs of oil exporting countries and the ones of oil importing countries. Just what differences would you mention with regard this about the interests, strategies and challenges of these NOCs? My question is to Mr. Alexandre, please.
Well, interestingly enough, even in oil seeking or oil producing, NOCs have to find their own way, and it's quite a unique way, I think I tried to say earlier. So NOCs don't have much of a template to go by. What Rosneft's trying to do now with TNK, where's the template? Who are they going to follow? What CNOOC will need to do with Nexen, same thing there. Well, perhaps you could say Sinopec ADAX is the template, but really integration hasn't taken place there yet, and needs to happen. So the distinction is actually each NOC is independent, individual, and different. I think with the resource holding nations, and Azerbaijan, SOCAR would be an example. Maybe Kazmunai Gas would be another example. Aramco would be a big example. I think the issue there that I'm seeing is being very close to the demand centers, and so being able to make downstream. So it's primarily a downstream investment, ensuring no demand destruction, ensuring alignment towards a green agenda. So it's more focus on the demand centers rather than focus on the production centers. So the resource seekers focus on production centers, so the Chinese focus on Africa. For example, I see, that's why I was saying the Middle East gravitating more and more towards Asia. Now what's happening with shale gas and shale oil. I think the Middle East has cause to be very concerned and to be looking towards the East, and become closer with Asia to ensure demand. They understand the demand picture, and they understand the growth picture. And that's not a simple task, because despite what we heard this morning, I think a lot of what's stated in the media and the press regarding what's really going on in Asia is quite erroneous and can be quite wrong compared to the real picture. So I think it's worthwhile for countries like Azerbaijan to have a deeper understanding of the demand centers, Asia particularly.
And I guess it's also a little bit of question of if you were looking for integrating your system, I guess BTT looking for upstream, versus if you build on the operational excellence you have and try to bring that to different regions in investments there. Any more questions? Okay, then I would say we're perfect timing. There's one more? Sorry. There was one more last one?
Hi, Nicholas Newman. Just a quick question. Do you think
It's hiding somewhere.
NOCs are able to be innovative enough to meet the new challenges they're going to face in Africa and everywhere else. And anywhere else in the world. Sorry. So I say again, do you think the NOCs are going to be sufficiently innovative to meet the challenges they will face in exploration and production and delivery, in meeting demand in the new markets they're going to serve?
I think that's yours, Alex.
We probably can all have a go at replying to that question. You know, when you look at the number of engineering graduates and you look at the size of the universities, when you look at the research institutes, you know, in Asia, and a great example is Brazil and Petrobras and the investment that they plow back into R&D, innovation, creating new technologies. The answer to your question is a definite yes. Innovation and technology is by no means the domain, will continue to be the privileged domain of IOCs. In fact, they let go of that for a while. I think they've returned, tried to get control back over it by investing more in R&D. The oilfield service companies for a while were having the upper hand. But we look to Norway, we look to Brazil, we look to the number of institutes, laboratories springing up around SEMPES, the R&D center of Petrobras in Rio, and it's absolutely phenomenal, and a lot of it's already starting to be applied. So I think another great example would be Saudi Aramco and some of the institutions in the kingdom as well, and the ideas that are coming out of that, and the leadership, for instance, that Aramco has in digital oil field and smart fields. So definitely yes. Would you like to comment on it?
I think it's a matter of time, because it takes time to catch up into that.
Good. Matter of time. That's a good final word. It's a matter of time. It's over. I think it's.